everybody. This is AJ with Trading Trainer, and I am here with a very special guest. His name is Jason Graham from the Option Workshop, and Jason has been studying with me for quite some time, and he's also gone out and studied with quite a few others, and he is the real deal. Jason actually trades in order to support not just himself, but to support his whole family of 5. He actually had a new addition just recently, and so we're all excited for him. But the scoop is Jason knows what he's doing. In this particular serial, this episode specifically, we're going to be talking about vertical spreads. And Jason, why don't you give us some insight on what about vertical spreads we're going to cover in this particular episode?
Okay, cool. So what I would like to talk about in this particular episode, and actually throughout this whole series, is something that I like to call a half condor. And it combines a directional bias of swing trading with a probability theory that a lot of income traders use, and it just the combination of the two ends up with some very consistent results. So to get into it, let's talk about let's introduce this particular spread. First, what I want to talk about is here's a long call, and I'm looking at this line here is particular trade is MNX, and price is around 235 here, and we're looking at a March 215 call. What we have here is a risk graph, and I know a lot of people are, for some reason, very opposed to looking at these, so I'll introduce them slowly. What we have here on the top is our profits, and on the bottom is our loss, and here's our zero line where we're buying the option. Our maximum risk in this position is what we bought this call for, and it looks like it's about $20,000. I can't remember how many calls this is. I think it's maybe 10. And our maximum profit on this is unlimited. As price goes up, our call will make as much money as it can. One thing that we're going to note about this, these dotted lines here are time decaying away. As price sits, some of this options premium will decay away. And that's pretty much it. This is our long call. Now, if I wanted to make this a vertical spread, I could stay long this March 215 call, and then short a March 220 call. And what this will do is we'll still be long this same call. We'll be short this. This will cap our maximum profits, so it's no longer going to be unlimited. In fact, it's going to be limited to, looks like, about $500 or so. It's also going to reduce our costs in this position by quite a bit. We're now looking at about a $4,500 position versus I think it was $20,000 or so. What we've done here too is taken away that time decay. Now time decay is actually working in our favor. If you look at these dotted lines here, as time decays away, our position will actually profit here. So this is our vertical spread. There are more things that we can talk about in terms of defining a vertical spread, but for the purposes of our episode here, I think this is good enough. So let's talk about some different types of vertical spreads. What I'd like to talk about is a very conservative vertical spread. So here's our chart of MNX, and I drew a line here at 220, showing maybe the placement. This is the same spread that we were just looking at, actually, the placement of our short strike for this spread, being well away from price. So if you can see price is way up here, we have a lot of wiggle room for price to move down. So if we sell this spread here, price can move around up here, and we can make the money in time decay. I'll show that here we're back to this same slide looking at the spread. So this is a lot of the wiggle room for price to move, and time can sit here and decay, or price can move up and we can make some money in price. A very conservative placement of a vertical spread, very far out of the money. Other spreads that you'll often see people use are an at-the-money spread, and here we've basically positioned our spread around price. So if we go back to our price slide here, here's price. We're maybe shorting an option up in here. We're buying an option down in here. And what it amounts to is a far cheaper position, or a cheaper position anyway, with a much more profit in it. Rather than $500, we're now looking at about $5,000, or about 100% return on this trade. Note also, it's got negative time decay. When we're on this side of the graph, time is not working in our favor, but when we move to this side of the graph, or when price moves above the apex of this spread here, time begins working in our favor as well as price. And then we have a very aggressive vertical spread, which would be above the money. And here's where we're placing our spread completely above the money. So if we go back to our price chart here, we're doing our trade maybe here and up here, somewhere off the price chart here. And we are speculating that price is going to be moving up in a hurry, or maybe not necessarily in a hurry, but it's going to be moving up quite radically. Our cost of this position is extremely cheap. Our maximum profits are in the thousands of % here. Time is working against us. This is very similar to a long call. In fact, it's just a cheaper way of doing something like that. Or it's a little bit different, but it could be considered a synthetic in some ways. So what we're going to be talking about is the more conservative type of trade that I like to call the half condor. Half condor meaning where condor traders will know that condors tend to look something like this, where you're doing a bull spread on one side and a bear spread on the other side, and you want price to stay within this zone. We're going to be trading directionally, so we're only going to do half of this condor. How do I delete this? Let's see here. How about that? So we're just going to do this half of this trade here. Very far out of the money. We're typically going to hold these between 15 and 30 days. During the majority of the episodes in this series, we'll be talking about bull spreads. We'll talk about bear spreads a little bit, but for the sake of conversation, we'll talk about these in the bullish direction like we have here. Price is going to be moving up. What I have here, if you notice throughout these, I have not said whether these are vertical bull spreads, bull debit spreads, or bull credit spreads. For the sake of this episode, let's just consider them to be synthetics. Same spread. So if we're selling, let me go back here. If we're buying this call and selling this put, we can buy this put. I'm sorry, buying this call and selling this call. I don't want to confuse everybody. We can buy this put and sell this put, and it will be the same exact position. I generally be referring to credit spreads in this presentation or in this episode for the sake of liquidity. When you're starting to scale these up, credit spreads tend to be more liquid than debit spreads, unless you're dealing with big time stocks like SPY and Apple or maybe Amazon. But even on those, there are some liquidity differences. I'll show you here in this option chain. If we look at, let's just look at this 95 here. This 95, I don't even remember what stock this is. I think it's F5. If we look at the open interest of this 95 put, way out of the money, the open interest is almost 500 versus the open interest of the call, which is, over here, which is 42. If we look at the volume traded, the call had 3 options traded that day. The put had 117. If we look at the bid-ask spread, the bid is 20 cents, ask 30 cents. We have a 10-cent bid-ask spread on the put versus the call, which has 28.50, almost a buck. What is that? 80 cents. So you can see that the put spread in this case is going to be a lot easier to trade. More people are trading it. The spreads are tighter than the debit spread. Not that the debit spread you can't trade, but often when you're trying to trade in a larger size, the put spread tends to be better. When we come back next time, what we're going to get into is talking about some of the 3 dimensions of verticals. We'll talk about price, and time, and volatility. We're also going to begin talking about the different rates of time decay, or the mobility of time decay, and the volatility of volatility.
Awesome. Well, I look forward to the next episode. Everybody, please stay tuned for the next episode in this serial where we're going to do exactly like Jason said, go for a deeper dive on vertical spreads. Thanks, Jason. I'll see you next time.
Take care.